Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today, I'm excited to talk to you about short strangles and how to use bar chart to get the most out of the strategy. A short strangle is a neutral option strategy that involves selling both a call and a put on the same underlying asset with the same expiration date, but at different strike prices. The strategy profits from sideways or neutral price movement and is successful when both options expire out of the money. The premium received is the maximum profit, and losses occur if and when the underlying asset's trading price moves beyond the strike prices in either direction. Let's have a look at bar chart for some short strangle trades that are available right now. Looking for short strangle trades can take a long time, but thankfully, bar chart makes it easy. To get started, simply visit barchart.com and click on Options, and then Short Strangle, and then you'll be taken to a page that shows you potential options that you can sell to create a short strangle. On this page, you'll get all of the most important information that you need for the trade, like strike prices, premiums, delta, and most importantly, the probability of loss and probability of maximum profit. Each column can be arranged from highest to lowest or vice versa with a simple click. Now, this default screen is enough for almost all traders to get started. But if you'd like to customize your results, Bar Chart's option screener also allows you to fine-tune the screen using different criteria. From the results page, navigate to the top left corner of the table and click Set Filters. This will bring you to the option screener page, where you can pick and choose from dozens of options and stock filters to customize your trade to your liking. To add different filters, you can click on Add a Filter field and type in what you need, or you can go to the drop-down menu and check the different categories and filters. Once you have one, simply click Add, and the filter will appear in your screen. This is the default set of filters for the short strangle. However, I'd like to make some changes. For example, I can change the days to expiration, so I'll go to 100 days. And you can set this to 200 or more days if you like, but I'll stick to 100 days since it gives me a lot of time for the trade to play out. Next, I'll click on ETF in the security type so that they appear in the search. Lastly, I'll scroll to the bottom where we'll find max profit probability. Now, many traders target a 50 to 70% chance of max profit probability on short strangles. However, if you'd like to be a little bit more conservative, especially when dealing with short positions and the risk of assignment, you can set the range from 75% max profit and up. Just know that the higher the probability of profit, the lower the premium. Alright, so let's hit See Results. And there we go. I got exactly one result, which I'll use as the example today. But before I do, I wanted you to know that you can also save your screener to reuse it later. And more than that, you can have Bar Chart email you at a specified time with your trades. Okay, so for this short strangle, we have GameStop, and its stock trading price is at $22.40 at the time of recording. The screener suggests selling a $25 strike call, collecting 20 cents, and selling the $21 strike put for 11 cents, bringing the net premium received to 31 cents or $31 per short strangle contract. Both options expire in August, and the trade has a 75.4% probability of achieving the maximum profit. Now, let's see how this trade could play out. To determine the point that the trade starts losing money, we need to know the break-even points on the upside and the downside. To make it easy, Bar Chart gives us this information on the results page. Now, if you'd like to calculate it yourself, you can do it by adding the net premium received to the short call strike for the upside break-even and subtract it from the short put strike for the downside break-even. Now, let's say GameStop closes at $24 on August 23rd. That means both options will expire worthless or out of the money, meaning you keep the premium that you received at the start of the trade, and that's $31 per short strangle contract. On the other hand, if GameStop exceeds $25 at expiration and closes, let's say, at $30, the short call will be assigned, resulting in a loss. The loss amount is calculated by subtracting the upper break-even price of $25.31 from the stock's trading price at expiration and multiply that by 100. In that case, this trade would result in a $469 loss. If GameStop trades at $17 by expiration, now the short put will be in the money, and you'll lose money on that leg. To calculate the loss, subtract the current trading price from the lower break-even price, then multiply it by 100 for every short strangle contract that you sold. For this trade, it works out to $369 per contract. Here's a table that shows the different price points that the stock could trade at, as well as the profit and loss points on the short strangle. As you can see, the trade will hit maximum profit if the underlying stock's price stays between the two strike prices. Beyond that, and the break-even points, the trade transitions to a loss, which increases the further the stock's trading price moves. Now earlier, I showed you how Bar Chart's option screener searches for potential trades in the entire stock market. You can also look for short strangles using a specific asset. To do that, visit barchart.com, search for the asset, which takes you to the overview page for the asset, and then go to the left-hand panel and look for short straddles and strangles. Click on that, and then you'll be brought to the results page for long straddles. From there, click on the Short Strangle tab, where you can sort using the column headers, change the expiration dates, or the strike price. To further refine your selection, you can also click Screen, and then set Filters, and add or change the filters just as you like I demonstrated earlier. It's that simple. The short strangle is a great strategy for when markets are neutral, stable, or moving sideways. Since you're selling options, you collect a premium. And since you're selling two options with different strike prices, your break-even prices are a bit more forgiving than just selling one option alone. Time decay also works in your favor, as the closer you are to expiration, the more the options lose value, and that benefits your positions. However, the short strangle is a risky trade, especially if the underlying security experiences large price movements. While the strategy offers limited profit potential, it carries potentially unlimited risk to the upside and significant risk to the downside. And because you're selling two options simultaneously, the trade may have significant margin requirements. Short strangles can be used to profit from neutral markets. However, its sensitivity to massive price movements may expose you to significant losses. To mitigate risk, you'll want to pay close attention to the trade as long as it's in play, and always use an option screener to assess the chances of profit and loss. Doing so will tilt the chances in your favor and make you a better trader. If you'd like more information about short strangles or other trading strategies, visit the Bar Chart Options Learning Center.